So, in interest rates, risk, and reward, part 3, we're going to conclude that area, and what we're going to talk about is commercial business credit ratings. Then we're going to move into loan pricing and terms, and then bonds, obligations of the company. What are they, and how do they work? If you have any questions, please let me know. They're rated, okay? And they are rated by, we'll call them the big 3 rating agencies. Those are Standard & Poor's, Moody's, and Fitch. So these are groups, companies, that look at the underlying credit, and they have developed their own models of evaluating them. So they're looking at the performance of the company historically, they're looking at what the future is like. So these 3 rating agencies will do a couple things. One, they rate the bonds. And a rating, it starts, and this is common for most of them, they start with AAA, which is the very, very best, and it goes all the way down to D, defaulting on these debt obligations. So you can see they're rated AAA all the way down to D. So AAA, AA minus, A minus, plus and minus. So there's a lot of degrading in there that you can really get different views of it. And of course, pricing goes along with it. The better the quality of the credit, the higher the rating, the lower the price. Okay? So this is just a matrix for you to look at. Here's the comparable when you look at Moody's, S&P, and Fitch. They all have a AAA. Moody's use small, they use big. But I think what's important to look at are these first 4 categories. This is what we call investment grade. And these are securities that can be used for certain pension plans, that can be invested by endowments and others. So that means prime, high grade, medium, low. These are all your good investment quality. There's always risk, okay? But in these, the risk is relatively low. Then when you go below this, this is often called high yield or junk, okay? And a lot of companies are in this range right here. They're non-investment grade. They're all BB in the case of this, S&P and Fitch. They're BBs, and this one is a BA. So these are your non-investment, but these are the ones that, yeah, they're pretty solid. They may be newer companies, they may have a little bit more risk, but they're not speculative at all. And what you find is that when they're investment grade, the yield is going to be less. As soon as you move over, and I don't like the word junk, it's really, it's higher yield. Okay, the junk is really down here in these are the non-rated. When we look at governments, and we look at obligations of governments, there's the first one is sovereign debt. That's the obligations of a country. Okay, so U.S. debt is rated. Those are also rated by the agency. Okay, the Fitch, the Moody's, the S&P. In the U.S., there are Treasury obligations. These are the direct obligations of the U.S. government. T-bills, T-notes, T-bonds. We looked at what they were, 1.65. Then there's government agencies. And these are not direct obligations of the government. However, that in case of certain evidence of default, the government will step in. That's Fannie Mae, Sallie Mae, Freddie Mac, etc. So this is sovereign debt, obligations of a country. Then we move into state and local governments, oftentimes referred to as munis. These are generally rated, okay, and they're rated by agencies. The small ones aren't. We call these are the fire departments and very small municipalities. Some of them are what we'll call full faith and credit, meaning that it's the full taxing authority that is behind the bonds, okay, or the debt that's issued by that municipality. They're called full faith and credit. Then there's those that have projects, sewer system, water system, fire trucks, or have a dedicated source of repayment. So they may have a bond that is secured by sales tax payments, There could be some that are by the tobacco settlement payments, which come in over time. So those are not full faith and credit. They refer to a specific source of money to repay. And there's, again, a little bit more risk. Now, states are more solid than our municipalities. We've saw Detroit go into bankruptcy. We've seen a number of smaller ones. We've seen counties. We haven't seen any state default yet. Now, when we look at the debt ratings of the different countries, we can see that the Moody's has rated, the U.S., Moody's and Fitch have rated us AAA. But if you notice, S&P downgraded us. They downgraded us a couple years ago when the Congress didn't pass a budget and didn't extend the debt ceiling. So you can see that in S&P's rating, Britain, Germany, Luxembourg are all rated higher than the U.S. And Britain and Germany and Luxembourg are rated higher by Moody's and Fitch, just the same level as us. Okay, so you can see this as to which ones are really high risk. The investment grade ones are the dark blues, so the high, good ones. And as you can tell, when you move down here to some of the others, and then you get into Portugal, Italy, Greece, okay, Spain, they're called the pigs, okay? That would be Portugal, Italy, Greece, and Spain. These are the ones that are less good, but it varies. Right now, we have, I think you can see Russia. Is Russia here? No, it's not. Russia is actually rated higher right now than Greece. So that's an interesting one. So that's how the commercial and corporate and municipal and sovereign debt are rated. Very similar to the person. It's about the ability to repay. It's just how they determine their ability to repay can change and can be different. It's a term loan, and it's for a set period of time, and it has regular repayments, and it has a maturity as a set date. It can be used for equipment and other longer-lived assets. Now, when it is secured by a piece of property, it is called a mortgage. Okay, there is a term loan is when it repays generally in monthly installments, and you try to match the term of the loan with the life of the asset so that they move concurrently. Then we have lines of credit. These are issued by a bank. Most of the time, they're used for working capital, short-term needs, and have a 30-day out-of-debt payment. Then there is a revolving line of credit, and this is available for a set period of time. Most of them are formula-based. So it'll say, okay, we will advance you a specific percentage of eligible receivables and inventory. That might be receivables that are all current, meaning that they all are due within 30 days. And a bank will lend a percentage of that, and for collateral, the bank takes that asset. Line of credit is often a fixed dollar amount that the company has available and isn't necessarily tied to a specific inventory or receivable. Next thing is, we call them, they're letters of credit, and these are used to finance trade. They facilitate trade. Like if you are a company, just say headquartered in GENESEO, and doing business in Shanghai, China, the buyer or seller of those goods, depending on whether you're importing or exporting, doesn't know you. So what happens is there's a substitute, or you don't know them, there's a substitution of bank credit. So the credit becomes to banks. And these letters of credit are issued by banks, and they literally put the bank in your place. Okay? So what'll happen is we might have in GENESEO Community Bank or Five Star Bank or Bank of Castile, so they normally need to go through another bank, okay, to get theirs accepted so that the client in China can handle it. So what you really have is these are done by the big banks are the big issuers of those. They're to facilitate trade. Then there's another one, it's a standby letter of credit, and that is a guarantee of performance or payment. So those are letters of credit in a nutshell. Pricing varies on the risk, structure, collateral, time period, guarantees. Some of it is publicly traded, so that there's always a bid-ask and a bid-ask spread. Some of them are private, fixed versus variable. Some interest rates are fixed over the term, some are variable. Some are based on pricing indices, such as the used to be the prime rate. Now the prime rate doesn't really mean anything because it hasn't changed in years. The Fed funds rate. A more common day one is I'll give you, there's three right now. There's a 30-day LIBOR, London Interbank Offered Rate, 90-day, but more commonly in the U.S., it's called, you look at the comparable maturity of treasuries, and it's called a spread treasury. So if we saw earlier that the treasury, 10-year treasury was 165, say, and your rate might be 200 basis points over treasury. So in that case, it would be 3.65. So it's generally, when it's variable today, it's tied to treasuries so that a bank can make money on it. LIBOR is also more common, but there's been some fraud there. Fed funds rate, not so much, because banks don't fund that way anymore. Rates would come back as to how the bank funded itself, but that's a more advanced topic which we don't need to get into today. And the prime rate has just sort of gone away. Now, the other things that go into loans that become very important to a company and to a municipality is the frequency of financial statements and deadlines. When do you need to provide where did that go? Okay, there you go. Frequency of financial deadlines. This has to be audited, unaudited. A lot of them have a certain debt or free cash flow, interest rate coverage ratios, EBITDAs, free cash flow. Now, you might have seen that already. So what will happen, where you have calculated the interest coverage ratio, the bank may say, okay, we'll give you this loan, but you must maintain this interest rate coverage, or you can't exceed your leverage of, or free cash flow must be this. And that becomes important because if those are not met, that would be a technical default. So banks are oftentimes using the ratios that you looked at last week and calculated. That's how they determine if a loan is having problems. Okay. Some of them will limit dividends or stock buybacks. Some of you have seen stock buybacks. You've seen dividends in the cash flow statement. Remember, the bank is trying to bank or lender is trying to protect themselves to get repaid. Okay. Limit capital expenditures and acquisitions. You've seen some of your companies have spent a lot of money, but banks will put a limit on that so that they're making sure they can get repaid. Those are loans. Now we have, at the same time, loans are from a document, are loans, and they go through a lender. That lender can be a commercial bank, alternative lender, brokerage firm, pension fund, any number of them. But then there are bonds. These are direct obligations that are issued by the company to investors. The term generally will be an original term and remaining. So if it's a 20-year bond and it's issued today, that bond would not be maturing, if you will, until 2036, because it's a 20-year bond issued today. That's the original. But if that same bond was issued in 2006, its maturity is going to be 2026. Okay? Interest is often paid quarterly or semi-annually. Principal often paid on maturity. Okay? Cash flow from bonds is interest payments and principal repayment. So you're always looking at what's the future cash flow, and you're using present value models to bring them back. Check that next piece out on that. On issuance, any bond is assumed that the price and yield are market. Okay? Which means that a bond has a market risk for the interest rates and has credit risk for repayment. The company records the debt on its books and generally doesn't adjust the principal amount. There's certain exceptions. We don't need to worry about them. And bonds are sold in the market. You can check this link out at your convenience. And Bonds 101 give you the process of issuing them. I'd encourage you both to look at that. Now, if a bond is publicly traded, the price of the bond is going to change based on market demand for debt at that credit level and the remaining maturity and credit characteristics. Okay, so that moves inversely. The price of the bond moves inversely to yield. So in the case that the bond interest rates go up, the value of the bond goes down, and vice versa. Because the overall cash flow doesn't change, it's just the value of that cash flow. So that concludes our lecture on interest rates, credit, loans, and bonds.